if you look really as to how the token's working, a lot of these tokens are inflating their supply, right? So what they're actually doing is they're printing more tokens to then give you those as staking rewards. So yes, it might seem like you're earning all these additional, coins or tokens or whatever they are, but the reality is they're just inflating their supply, which is no different to what the reason why the purchasing power of fiat currency becomes the way it is because they inflate the supply. Welcome back to another episode of the Ben and Berg Show with your favorite MBA and high school dropout, where we talk everything crypto, business, and personal growth. And we've been talking a lot about personal growth. We've had some cracking interviews that might already be out, and we've got some personal growth ones coming out in the future. But today we're going deep on Ethereum and ways you can actually stake your Ethereum, earn a yield without needing the 32 ETH minimum that you require if you're going to set up a node. So as we know, Ethereum moved from proof of work to proof of stake last year, and a way that you can validate the Ethereum blockchain and actually earn a return on that is through staking your Ethereum. You're basically giving your Ethereum to help secure the network, and then you can be paid rewards for making that action. But the way to do it normally, or I guess, to actually do it as a setting up a node, you actually do need 32 Ethereum, which is around $60,000 to do that, which most people don't have. So there's a really cool way of doing it, which is called liquid staking, which is an area that we really like. And today we're going to walk through the pros and cons of doing it on liquid staking, how it works, and three different options to do it. How are you, Bergs?
Mate, I'm going really well. I'm excited to do this episode, and just looking at some of the work we've got on the platform, particularly by Nick, and everyone was poo-pooing proof of stake and it's all going to hell, it's going to zero. He was the one guy that's like, no, this is a good thing. Here's what's going to happen. Absolutely nailed it. Went super deep, went into the protocol level, everything that was happening there. And then even after, when people are able to take their staked coins out, he's like, no, this is going to be a good thing. And he explained exactly why. Nick, shout out to you. I love you. I might even be in love with you, mate. And I'm really looking forward to going through ETH staking today, Ben.
Yeah, so this resource that we're walking through is something we delivered to our members last week inside the collective platform. So we've got a couple of thousand investors that subscribe for sort of insights and analysis. Those people that really want to upgrade and win in crypto, we try and give them some really good content, and sometimes we share some of that on Ben and Bergs as a little bit of an insight is what we do, and that's what we're doing today. But to get started, really, what even is liquid staking? Liquid staking is basically a way that you can pool your Ethereum with others to deposit into the Ethereum network to earn those staking rewards, and they take a fee. So rather than having to have that 32 ETH to participate, you can basically, as I said, pool that. It's more user-friendly. It's a more passive way to pool your crypto with people you don't know, and then you can enter liquid staking to earn those yields. Now, there's three kind of main ways you can do this through liquid staking. Just quickly before we do that, the other way to do it, if you want to go straight through what we call liquid staking protocols, where you go direct into the smart contract of Ethereum, you can do that through your ledger. It is, as I said, it's a little bit more difficult with the amount of crypto you need to do that, and there's some other ways you can do it, but we won't talk about that today. Today is more for predominantly, the most of us here that don't have that 32 ETH. You can do it through three main ways, and they have pros and cons. The risk here as well, before we get into everything, is like there is always risks with everything. You have the smart contract risk. We have regulatory risk, where we've seen the SEC announce things around securities and different exchanges around staking. There's liquidity risk. There's a lot of risk in staking, so please be aware of that. It's actually something that I don't do. Bergs, do you stake your crypto?
No, I don't. I don't think the returns at the moment for me are high enough for me to monitor it and do it. Although with liquid staking, I don't have to run my own node or validator with 32 ETH. I can do a small portion of it. Yeah. So it's something I'm definitely going to look into. But at this point in time, I don't stake.
Yeah, neither do I. I'm not saying it's not a good idea. But I'm in the same camp as Bergs on this one. I just like to sit and hold my Ethereum and crypto. But for some people, you're going to want to stake your ETH. So today's a little bit of a guide. So number one is Lido. Lido is the largest liquid staking protocol. It's basically a decentralized platform where you can put in your ETH. It's managed by a DAO. So Lido DAO basically control how the protocol works, and by holding the Lido token, the LDO token, you can actually vote on different things around the parameters, the fees, the operators, things like that. So you can actually buy Lido, the underlying token for the Lido platform, if you want. And if we look here, like there's a chart that we might link to in the show notes for those that are members of Collective Shift. We've actually got like a screenshot here of the balance of liquid staking protocols, and Lido is by far the biggest. And we're seeing a bit of an upgrade coming, Lido V2 in the middle of 2023. So with Lido, you're looking at around, as of April 2023, a 4.5% annual return rate. You can get your distribution of the staking rewards daily. Lido takes a 10% commission. It's relatively easy to use. We're sort of rating this like a medium user friendliness and medium accessibility. So if you're a beginner, it's not a bad platform to look into. And that token, as I mentioned, is the LDO token. Next we have is Coinbase. So Coinbase is a centralized exchange, probably the most reputable exchange. It's based out of the US. It's listed on the NASDAQ. And you can use Coinbase to stake your Ethereum as well. All you need is a Coinbase account. You need to verify your identity, and you can basically get involved with that. Downside risk here is that the SEC may be pursuing Coinbase for offering this as an unregulated security. Because there's an expectation of profit. So we do need to be wary that the SEC haven't put a real framework around if staking and Ethereum is a security just yet. Coinbase and a lot of people inside crypto are saying it shouldn't be. Some people in the SEC think it should be. There's been no decision on that yet. So just something to be wary of. Coinbase take a little bit of a higher fee. They take 25% fees instead of 10%, and a smaller annual return. You're looking about 3.8%. But it is, the user friendliness is super easy to get involved with as Coinbase. It's a known exchange.
Yeah, and I think if you're already holding your ETH on Coinbase, you've accepted the exchange risk. You're holding it there. You're not doing self-custody. So there is an option while you're holding it there to earn additional yield, and you're still accepting that risk. So I would say the risk is not increasing by that much because the risk is more the exchange itself, in my personal opinion. So that's a good opportunity to earn additional yield.
Yeah, great point, Bergs. And third but not least is Rocket Pool. So Rocket Pool is actually a Queensland-based company, the most decentralized. Again, another staking pool that has the ability to put your Ethereum in, and then also has some of the fundamental principles of decentralized finance. So it's non-custodial, self-sovereignty, et cetera, et cetera. You can also buy the underlying token LSD, but when you're sending your Ethereum to Rocket Pool. And the way Rocket Pool works is that they set up mini pools, so you only need to pool up to 10.4 ETH instead of the 32 ETH. So you can obviously deposit less than that, but that's how they get access to the network. They're looking at a much higher rate. Annual return rate is 7.1% as of April. 15% commission fees. Probably the lowest user friendliness out of the three I've just mentioned, but easy to access. Pretty low liquidity and volume though. So in terms of like Lido, it's much less in terms of the amount of people using it. So there's sort of the three different major players within the liquid staking field. As we mentioned before, like there is a lot of risks with liquid staking, just staking in general. Ethereum. If anything, if you're wanting to like stake your crypto, like I'd probably say ETH is the least risky out of the most risky. But yeah, there's sort of three different options there if you really want to get a yield on your ETH.
I love that these options exist. It's more innovation and it's more opportunity to earn capital, and people will need to select whether it matches their risk profile and whether it's right for them. And we touched on some of the risks before, and we'll go through them now. Where, and I love this, cartelization. So if you've got a DAO or something controlling a certain area, or if you have a validator that gets too large, they can then collude. If they own a significant percentage, they can collude for their own benefit. And we tend to see this with pretty much any business, right? Like you see it with, although I won't admit it, like whenever you have a big four, you have like mining or banking, and they will collude. They're all on the same boards. They'll do things like price signaling, but these guys can actually manipulate things for their benefit. So that's something you need to be aware about. And there are tools out there, particularly June Analytics, where you can see how large the validators are. But then within a validator, how many people own a specific amount of the tokens. Like if someone or a group owns 90%, that's autocratic. They can just vote on anything they want. So that's something you need to be aware of. Other ones are smart contract risk. Again, this is nascent technology. They're building it on smart contracts. These things have been tested, but there can be future things or exploits that can come along. So know your smart contract risk. Regulatory risk. This comes with, like we were saying, with Coinbase, or potentially your regulator, whether it's the SEC, ASIC here, determining that ETH is a, what do we call it?
Security.
Security, thank you. ETH is a security.
Yeah.
Then that will change the way that you interact with it and whether you're able to hold it or not. Systemic risks as well. So the whole crypto ecosystem is intertwined. A lot of dominoes can fall. And like nothing beats just holding that protocol asset and having self-sovereignty around it. Nothing beats that. But again, risks do come with that. And you need to know, are you actually holding the protocol product itself? Like, are you holding ETH? Or are you holding a derivative product of that asset? Just know what you're actually holding. Again, depegging. So LSD is traded on an open market, and coordinated efforts to either short that or put pressure on it, or the underlying asset, that's an extremely small risk, but it's still a risk. And again, liquidity risk. If there's not enough liquidity, then the LSD token may suffer while you're attempting to trade it. So I love that these options exist at this point in time, and the yields that are available. I personally won't be taking any of these up. I might explore some of them just to see how they work with a very small amount of ETH, just to see how the protocols work, what the experience is like. I'll do that on a new wallet, an address that is segregated from what I'm doing with my other stack, because I do like exploring it. But in terms of putting my stack in there, I personally won't be taking this up, but love that it exists.
Yeah, it's a really good point, Spurks. And it's also important that I know a lot of other people stake different chains, and you know, there's a range of different ways you can do this, and also different tokens that offer rewards. It's important to note that you need to look into some of the token economics of some of the projects that offer these rewards. Some of them are offering 10, 15, 20% yields, or you know, APYs, or whatever they call them. In that individual token. But if you look really as to how the token's working, a lot of these tokens are inflating their supply, right? So what they're actually doing is they're printing more tokens to then give you those as staking rewards. So yes, it might seem like you're earning all these additional, coins or tokens or whatever they are, but the reality is they're just inflating their supply, which is no different to what the reason why the purchasing power of fiat currency becomes the way it is because they inflate the supply. So that's different to Bitcoin. Ethereum has a very low inflation rate. I'm not entirely sure what the current inflation rate is, Bergs. I mean, I'm pretty sure they were aiming to get it to near zero. But it's important to note that if you're staking on a lower token, it's important to look at the token economics. And if you need help with that, we have those details inside the Collective Shift platform. So as an insider member, you get access to our reviewed assets, where we have a lot of those tokens in there, and we actually detail that out for you to help you on your research.
Yep. Exactly right. And it does get complicated. You'll need to see the issuance. You need to look at the smart contract. You need to see where that issuance is coming from, where it's going, and then who's buying those tokens and how they're being market sold.
Yeah, there's a lot in there. So that's why we're here to help Collective Shift. You know, we've got over a couple of thousand members now, and really helping you get ahead, but also save you time. So we've got a team of 6 analysts that are doing a lot of the work for you, so you can get in there, especially from the altcoin perspective. We've got a lot of great analysis in there, giving you what we like, what we don't like, the ins and outs, completely no BS. So if you've only got an hour a week, giving you exactly what you need in that platform. So go over and check it out, collectiveshift.io. Bergs, I think that's it for today. Thank you very much.
Thanks so much, mate. I enjoyed going through that. A bit more knowledgeable now.
Amazing. Thanks so much for listening, everyone. If you have a friend, a family member, colleague that's into crypto, might be getting into crypto, maybe they're staking crypto on some sort of random token or random exchange, make sure to send them this episode. We'd love to help them out. And as always, please leave us a review if you liked or even not liked the podcast. We'd love to hear your feedback, and we'll see you next time.
Thanks so much, folks.